Hello everyone. Hey, it's Owen. Pat and I were just talking, what would you do if you had a position in Apple and you want to hold it through earnings? Well, I do. And I guess as a matter of full disclosure, I've got a lower cost basis in this, so it's been a longer term position for me. I don't really want to sell it. I will if I get called out, so keep that in mind that that's one criteria that I'm going into this trade with. But I'd really rather hang on to the shares. So I'm going to be looking at the November 15th, okay, 16 days out, front month options, and we're going to be collaring the trade, but we're going to reduce the collar by selling an out of the money put. Now, let's take a look first of all at what our expected move is. So I'll look at the weeklies just to get an idea. Our expected move, we're trading 242.5 roughly. So our options are trading just under 6 and about 6. So call it 12. So $12 on a $242 stock, we're looking at somewhere just close to 5% move, right? Under 5%, 4.7 to 4.9, I believe is what it was about an hour ago when I looked at it. So let's go back to the front month options. And I'm willing to risk, since the expected move is about $10, $11, I'm willing to let it float that much. So I'm going to buy a 232.5. I'm going to buy $10 out of the money. And then I'm going to go up and I'm going to offset that with a 265. I'm going to sell the 265 call, which brings my debit to 266. I don't want to spend 266, so I'm going to go way out here out of the money, and I am going to sell the 217.5 put to bring my cost down to $1.69. Now let's take a look at this on the Analyze page and see what we got. Get rid of a couple here that aren't okay. So this is the TOS Analyze page. If you use TOS, you're very familiar with this. I'm not going to go into great detail about this, but essentially anything above 265, okay, we start to lose money on because we're going to probably get called out. Now, I might decide if we're trading in here somewhere and I'm running out of time, I can always roll that call, or I can buy it back, or I can get called out, right? Those are the options that you have. And then with the downside, which is really what this trade is all about, the downside risk, anything below 232.5, it goes into the money. So at that point, I can sell the option, I can exercise the option, or I can I can carry it all. And I guess those are my two options going into expiration, right? I'm not going to carry this all the way into expiration, but those are my options going in. And then way down here, I've got a 217.5 that I'm going to probably just let it expire worthless. Now, if it gives me an opportunity, I might sell something against that and turn that into a short vertical. Okay, but right now we've got a debit trade of 166, reasonable to go into earnings to protect my trade, with a potential upside of 265 on Apple stock. All right, so that covers the collar with the tail. That's going to provide me a little bit more on the give me a little credit so I don't have to pay so much for it. Now, I want to queue up a trade that is a bullish bias. I'm going to put this all on today ahead of earnings, and I want to be prepared to be able to take advantage of Apple's run to the upside. Okay? If we have a surprise earnings and it goes up, I want to be able to take advantage of this. So I'm going to put on a bullish backratio spread, and I want to do it for very, very little money. Let me get that queued up. So with an expected move of $11 or so, I'm going to come in just one strike from that expected move point, okay, 242 to 252, and I'm going to buy two of the 252 halves, and I'm going to offset that purchase by selling one of the 245s. Okay, these are calls for a 12-cent debit. And let's take a look at this on the Analyze page. So our risk is at expiration. We're risking $741 on a single round of contracts, right? It's a 2-to-1 ratio. Let's see if I can bring that into frame a little bit. We'll just get rid of this one. How's that? That'll do it. Okay, so we're selling, we're buying 2 and selling 1. It's a back ratio spread. So the bias is to the upside. So anywhere we trade at expiration above 260, we're going to be in the money at expiration. Now this isn't going to be something that's going to be held till expiration. It's either going to be cashed out, or it's going to be rolled in some fashion, okay, prior to expiration, probably prior to expiration week. So as Apple trades up here, okay, obviously the trade gets very profitable. You can watch this number right here in blue. You can see how just a single contract, a one-off back ratio can be profitable. And our risk is very minimal, right? We've got 11-cent risk on this. So $11 risk if it trades down below our short strike. Okay, down below, our short strike is at 245. So down where this line breaks right here is the 245. So anything below that, okay, we're going to just, the trade's going to go away for 11 cents. And if we hold it till expiration, our risk is $760. Like I say, not a trade to carry through expiration. So I just thought I'd throw that out there. If you guys want to play with it, this is the simulation in TOS. You guys have access to this if you trade the TOS platform. It's great to get in here, load up trades, and look at all this. What I want to do now is I want to set up that other trade and put it all up in the Analyze page and show you what that graph looks like. All I've done is I've just loaded up that first trade that we're talking about. Okay, we're protected down to 232.5. We're selling the 265 to offset our cost just a little bit, and we are selling the 217.5 to bring our cost down even more. Okay, for $1.77, an 11-cent debit, and this is what the risk graph looks like. This is a very favorable risk graph in my mind. Now, you can look at the expiration point and see that at expiration here, we're looking at a loss of $925, okay? But like I say, we're not going to hold this to expiration. So I'm looking at more of the purple line, gives me some options to flip this into something else or do some other things with it. My risk is very, very low. I'm capped to the upside. This is because of this 265. If we took that out of the mix, just as an example, okay, there's more what the back ratio looks like. Okay, but since we're selling that to offset cost a little bit, that's what gives our cap to the upside. Okay, now look at our risk to the downside. We just don't have any. So if Apple sells off big, we're protected, and that's what it's all about. That's what options are really designed for, is to mitigate risk.